Everybody. Good morning, everybody. Thank you so very much for joining this morning on this very important workshop on how to own your own money, credit repair workshop. We know that during the pandemic, hopefully it is the last pandemic. During the pandemic, a lot of people struggled with contracts evaporating and just not getting the business that they were used to getting before, and that really impacted their financial stability. So credit repair is really important. It helps you grow and move forward with your company, and our job is to help you scale up your business. My name is Alika Kumar, and I'm accompanied here by consultants from the Arizona Minority Business Development Agency's Business Center, Ivetu Riondo, who you see on the screen, and Vanessa Bel Castillo. We are funded by the Minority Business Development Agency, which is part of the U.S. Department of Commerce. It's a permanent agency under the U.S. Department of Commerce with a brand. Just a few months ago, it became a permanent agency. It's been around for over 60 years. We now have an undersecretary, Mr. Donald R. Cravens, who is heading the department. We have been locally operated by the Arizona Hispanic Chamber of Commerce since 1997. So we've got a lot of experience working with minority businesses. I myself have been with the center for 18 years. So we are all very passionate about growing your business. And as you see on the screen, it says grow. Let's dream bigger, let's achieve more. And that's what we're all about, helping you grow your business and achieve more. So our focus is to help you scale up your business and build capacity so that you can create more jobs and be globally competitive. The Minority Business Development Agency has centers all across the country, and I won't go into those details right now. And who do we serve? We serve minority-owned companies that make $500,000 or more. However, we don't turn anybody away. We always provide resources to every size company. We especially like high growth companies. To be eligible for our services, you have to be one of the minorities in the nation as defined by the U.S. Department of Commerce, and that's African Americans, Hispanic Americans, Native Americans, Aleuts, Asian Pacific Americans, Asian Indians, Eskimos, and Hasidic Jews. So why are you here? You're here because you want to strengthen your business and grow your business. What we do at the Arizona MBDA Business Center, and by the way, we do it for free. It doesn't cost you anything. We provide business development, capacity building, consulting services. So if it's financing you need, we give you access to capital, whether it's loans, investments, whatever types of things that you need, we connect you to those resources. We also give you access to capital, to contracts. We subscribe to databases, bid databases, so we can give you a steady stream of bid opportunities, private and government, so that you are able to take those on. And we also help with bonding, teaming, if you're looking for someone to team up with, and to help you with certifications, because as a minority-owned business, there are many certifications you should be considering getting, which help you reduce the competition and get more access to opportunities. So we've made it our business to cultivate yours. We used tools like the Growth Wheel to look at every aspect of your business and give you strategic consulting and tools and resources, and you can use this tool yourself. You get access to it as a client of the center to look at the different aspects and to grow your company with a 360 view. So we look at your business model, the way your organization, the structure, the infrastructure, your marketing and branding, and to make sure that you're really operating smoothly. We give you access to markets. We can also help you with exports. 95% of the world market is outside the US borders. So we help you with that. We help you, like I said, get the certifications you might be eligible for. And we also do business-to-business matchmaking. So there's a lot that we do. If you're interested, please contact us. We'd be happy to talk to you and help you take your business further. And for all of those who have signed in, all of our guests, please put yourselves on mute. So once the speaker starts speaking, we don't have any interruptions in case he's speaking in the background. Thank you so much. We also help with global entrepreneurship. So did you know that exports means anytime anybody pays you with foreign money, that's an export. So you could be sitting right here. You don't need to be exporting widgets and gadgets to another country. You could be providing a business consulting from right here to a foreign company who's paying you with foreign money, and that's considered an export. So for example, ASU is an exporter because they have foreign students coming in, taking classes, and they get paid by foreign money, right? So that's an export. So if you're interested in exporting, it's a good way to hedge any recession that may be coming up, any downturn in the market, a good way to protect yourself. And we also help you with access to capital, as I mentioned earlier. Additional services, we do a lot of workshops and seminars like the one today. We also do business-to-business forums. We provide referrals, lots of services. So thank you so much for joining. I'm going to stop my presentation and introduce you to Stephanie Black, who is with Andorra Capital Repair. Stephanie, take it away.
Hi, I'm Stephanie Black with Andorra Credit Repair. So I have been in the credit repair industry and financing industry for about 20 years. I'm also a licensed loan officer. So one of the main things, it's very important that, I love the master your money, because mastering your own credit is really key when you have your own business. Okay. So you want to have a very good personal credit score as well as a good business credit score. So I'm going to go over basic things with you. I'll go a little deeper today so that you understand exactly how credit works. I'm also going to go over credit scoring. I'm going to go over the different credit models because there's a lot of misinformation out there. So since I guess we're not going to do this interactive, I will go ahead and go through my entire presentation and then take questions at the end. So if you do have questions, it's a lot of information that I'm going over. So if you do have a question, probably the best way to do that is just type that question into the chat when you're thinking of it, so that we can address those at the end, because I'm sure everybody will have quite a few questions by the time I'm done. So I'm going to go ahead and share my screen and stop my dog from barking. Okay, let me know if everybody can see the screen.
Yes, we can see you.
Yes. Okay. Okay, so one of the main things that happens in the credit industry is that people look at their credit scores. Okay, so there are, let me move this out of my way. So credit scores can be very, very different depending on where you get them. So a lot of times what we're seeing is that people will come in and they'll say, okay, I have a credit score of 680. Say they're looking to get a loan or a business loan or something like that. And they're saying their credit score is about 680. Well, what happens is that a lot of times they're looking at Credit Karma rather than FICO. So what I'm going to do is go over some of the differences with Vantage versus FICO and where you're getting your credit scores, because they're not the same, and different credit scoring models are used in different lending purposes. Okay, so we're going to talk first about Vantage versus FICO. Okay, a Vantage score, this model was created by the 3 major credit bureaus. This is what you're going to find when you're looking at Credit Karma. Okay, so if you go get your credit score from Credit Karma, this is a Vantage score. Okay, this is not used at this time for lending. Okay, it's going to be in the future, because the FHFA just actually adopted some new scoring models, but it's not going to be going into effect for the next probably 2 to 3 years. So currently, a Vantage score is where you're going to find it. Credit Karma, you're going to find a Vantage score. Typically, if you use a credit monitoring service like Identity IQ or Smart Credit or something like that, you're going to see a Vantage score. Again, not used for lending. FICO, which was developed by the Fair Isaac Company. Now that one is actually used for lending, but there's multiple FICO scores, and we're going to cover those. So we're going to talk about each one of these so that you understand where the scores are coming from and why they're so different. So the Vantage score, again, the credit bureaus, they created this model, okay, to compete with FICO so that consumers had a choice. And again, it never got adopted with the lending side until now. The number one influence on a Vantage score is payment history, and also it is utilization factor. Utilization factors in very heavily on Vantage. So if you have a low utilization ratio, you're going to have a really high Vantage score, okay, which may not reflect the same in FICO, and we'll talk about that in a moment. So again, Credit Karma, Identity IQ, Smart Credit, these are the places you're going to find a Vantage score. One main difference is that on a Vantage score, it only takes 1 month of credit history to actually report a score. Okay, so this is different. When someone comes up as NA or they do not have a credit score, it's because they don't have any actual credit that they've been paying on. So the bureaus, they can't actually reflect a score. So on a Vantage score, 1 month of credit history, get a credit card, reports one time, you're going to actually have a score. And you'll see as we move on that this does not translate the same to FICO. Mortgage late pays are factored heavily on a Vantage score. Okay, so one single 30-day late will factor fairly heavily. Okay, FICO scores 2, 4, and 5. This is a mortgage score. Okay, so when you go to apply for a mortgage, all banks and mortgage lenders are using FICO 2, 4, and 5 for the most part, probably 95% of them. So this can be actually 100 points different than your Vantage score. Okay, so this was created by Fair Isaac. Again, the number one influence is payment history, followed by utilization, same as Vantage. Mortgage lenders and bankers use this credit scoring model. Again, this actually requires 6 months of credit history to get a score. So if you don't have credit, if you're coming up as an NA or you have no score at all because you have no active credit, whereas a Vantage score in 1 month, you will come up with a credit score. If you go to apply for a mortgage, then and a loan officer pulls your credit and you only have 3 months of history, then you will still not reflect a credit score. It takes 6 full months of credit history to reflect a credit score. Okay, and all late payments hold the same weight. Whereas in Vantage, mortgage late payments are factored more heavily. Okay, but a credit card late payment is factored less heavily. Okay, so this can be very confusing. Okay, FICO 8. This is the credit scoring model that they're using if you're applying for a credit card. Okay, so if you go to get a credit card, it's FICO 8. So one single 30-day late payment is not factored as heavily on FICO 8. Okay, whereas in FICO 2, 4, and 5, and we're going to cover this in a few minutes too, one single 30-day late payment on FICO 2, 4, and 5 is actually a 100-point hit to the credit score. Okay, so one 30-day late payment is not factored as heavily in the newer model, which is FICO 8. Multiple late pays are factored more heavily. So that's because they're looking, this is credit card lending. So they're looking to see, okay, how are you managing these credit cards? And if you're not managing your credit cards well and you have multiple late payments, you're much higher risk. Okay, collections and FICO 8 under $100 have almost no importance. Okay, they don't even factor those. Credit utilization is factored much more heavily in FICO 8 because it is for credit card lending. Okay. Piggybacking is factored out. So piggybacking, just so you know and understand what that is, when you're added to someone's credit card as an authorized user, you can get, it can help your credit score. So say you have a short credit history, a thin history, and you get added to somebody with a 10-year history, that can actually help you. But it only helps on FICO 2, 4, and 5, because that's the oldest classic model for mortgage lending. That still works, okay? But on FICO 8, they factored that out. So that is no longer a factor. So if you have an authorized user account, that doesn't help you if you're trying to get credit cards, okay? They factor that completely out. And so again, this is used mostly for credit card lending, FICO 8, FICO 9. Okay, FICO 9 this is more of the medical one. So for FICO 9, medical debt has less of an impact on the score than other types of debt. Okay, so this is one of the things too that happened over this last year in July. Of FICO, the credit bureaus actually stopped reporting all paid medical debt. Okay, so if you had medical debt on your credit report that you had paid and it's been sitting there showing paid and you suddenly saw that disappear this last July, that's why. They've removed all medical debt, because as they're creating these new FICO models, and especially FICO 10T, they're starting to remove some of these things. So you have the medical debt has less of an impact on the score than other types of debt. Paid collections are being disregarded now, okay, in the score calculations. The newest versions, FICO 10 and FICO 10T, which means trended data, is also being disregarding paid collections. That is something we have been hoping for years and years, just so you know. It never made sense to me when you have a collection on a credit report that once you've paid it and cleared that debt, that they still penalized you for it. You know, in collections, if you pay an old collection, in FICO 2, 4, and 5, this is still the case, but if you pay an old collection and you're trying to get a mortgage, it actually hurts your credit score, okay, unless it's deleted entirely. So that has never made a lot of sense to me. So I'm really happy to see these new models coming out. And once they're implemented into the mortgage, it's going to be a game changer for many, many people. Rent payments are also now included in FICO 9, FICO 10, and FICO 10T. Now, previous models and iterations of FICO, this is not included. So when you're having your rent payments calculated in your FICO, or adding them and maybe paying for a service to do that, if you're doing it for the purpose of getting a mortgage, then it's not going to help you, because FICO 2, 4, and 5 actually does not factor any of that in. Okay, so know that. So this will help you in the future if you're looking for, you know, mortgage and certain things, but unless they're pulling FICO 9, 10, or 10T, those rent payments are really not making any impact on your credit score. Okay, so there's 5 basic information zones on your credit report. And these are the things that actually report to your credit report. You have your personal information, which is just your name, your address, usually a date of birth, your past employment. You have your credit accounts that are going to show up. You have inquiries. You have your public records. The only public record that actually shows up in a credit report now these days is a bankruptcy. No other public records report to the credit bureaus, Experian, TransUnion, and Equifax. So Tax liens, judgments, those are not going to show up on your credit report. It doesn't mean you don't have them and they won't show up if you go to get financing, but they're not going to show up at the credit bureau level. They're going to show up on LexisNexis. Okay, so if you think you might have a judgment or you've been sued by somebody, something like that, you're going to want to pull your LexisNexis credit report. You can go right online, just Google it, get in LexisNexis credit report, and you can put in your information and they will send you a copy of that report so you can see any public records that may be on there. The other items that will report to your actual credit report are collection items. Okay. So we are going to, well, we'll run through this slide really fast. So what's actually considered in your credit score are trade lines, which are your credit accounts, credit inquiries, and credit inquiries, they only report for 24 months and they only actually affect your credit for 12 months. So it is important that you keep your inquiries low. You do not want to have a lot of inquiries for sure. No more than 2 per year if you can help it. But again, 12 months, and that's the only time they're factored in. Collections are considered in the credit score. Public records, bankruptcy public records are considered. What is not considered is age, which I don't quite buy here. They say age, this is actually from FICO. So they're saying age really is not factored in a FICO score, but that doesn't make a lot of sense to me because time, length of history on the credit bureau is factored. So to me, that's kind of maybe age is factored a little bit. Your address does not factor in your score. Employment does not factor in your score. What you make is not factored in. Your race is not factored in. Gender is not factored in, okay, to any credit scores. Okay, so we're going to go through the 5 factors of FICO. There are 5 main ways that make up your credit score. Okay, so there is payment history, which is 35% of your overall score. Then we have utilization ratio, which is how much money have you charged on your credit cards in relation to your limits. Length of credit history, 15% of your credit score. Types of credit, which is 10% of your credit score, and new credit, which is 10%. So we're going to run through these. I have some really cool slides in here showing that I got directly from FICO at a FICO training that I went to last year. That gives you a really good idea of how this factors in so that you can get a real good visual. Okay, so 35% of your credit score is payment history. Okay, how recent is the most recent delinquency, collection, or public record item? That's a big thing. Okay, recovery time, it does take about 12 to 24 months to recover from a late payment. Okay, so one single 30-day late payment, especially on FICO 2, 4, and 5, is worth about 100-point drop to the credit score. Okay, any of the other mods, it's still anywhere from 60 to 100-point drop. It's a big deal to have a late payment on an open account. Okay, paying old collection accounts can definitely drop your credit score on the older FICO models. On the newer ones, not so much. They actually factor that in. So payment history, this is what I really want you to see. This is such a great visual to see the risk factor that FICO is looking at on late payments. All right, so this is the months since the most recent major delinquency on your credit report. And a 30-day delinquency and a 60-day delinquency also makes a difference. The worse the delinquency, the worse the hit to the credit. So as you can see, from 0 to 11 months, the risk is extremely high. This is why you get such a huge drop when that happens. Okay, once you hit that 12-month mark, look what happens. 12 to 23 months, that risk factor is cut in half. Okay, literally in half. So you've recovered now a lot of those lost points. About half of those lost points are coming back now. Okay, and once you get into that, 24 months, it goes down even more, and then it just gets better and better as it ages out the full 12 years. But as you can see, it's the last 12. A lot of times what lenders are looking for on any type of lending is a look back on the last 24 months. Okay, so you can have derogatory things after that, but they're looking at a look back. So if you say a mortgage, if somebody DU, which is a desktop underwriter, is actually doing a look back of the last 24 months. Okay, so one single 30-day late payment can drop your credit score about 100 points. I would say that is the major takeaway from this. Credit utilization. Okay, this is again is 30% of your credit score. This is massively important across all models. Revolving credit accounts are great. You need to have them. They're very important. If you want a high FICO score, you definitely want to have revolving accounts. But I got a little nugget from FICO last year on this one, because we've always said, as long as you keep it under 30%, then fine, no problem. What FICO is telling me, and they have a chart showing, which I'll show you in a moment, your maximum point value that you're going to get for utilization is if you keep your balances between 6% and really 19%. 6% is the sweet spot. That is where you're going to get the highest possible score in this area, okay, for utilization. So I know it's a little bit random, 6%, but it actually works. We've been testing this over the last year. I've had my clients putting everything down to 6%, and we're getting nice improvements. Your credit score will be higher at 6% than it will at 0. Okay, so maxing out credit cards until FICO 10T, which is trended data, becomes more mainstream and they're using it for everything. If you max out your credit cards currently, and even if you pay them off every single month, that is still going to hurt you, because it's going to show that you're maxed out every month rather than paying them off every month. They're going to report the high balance for the month. Now, on FICO 10T, that's not the case. It's trended data, and that's what trended data is. That's looking back and saying, okay, they're maxing this out every month, but they're paying it off to 0 every month, so you're not getting penalized for that. But again, for now, you need to keep them low. Okay, this is the risk factor. So as you can see, 0 to 19%, that's your super low risk for a FICO score, okay? 20 to 39%, and as you can see, going up to 100%, huge high risk, okay? So the more maxed out you are on these cards, the worse your score will be. I have seen people being maxed out on credit cards with high limits that are down 100, 150 points just because of utilization. Nothing else. No other derogatories on their credit report at all. Okay. So the one massive takeaway from this one is maxing out your credit cards is not a good idea, even if you're paying it in full every month at this point. Okay. Length of credit history. This is just how long have your accounts been established. This is what I was talking about earlier. I really feel like age does play a factor in a FICO score, even though they say it does not. How long have they been established? How long, how many months has the account actually been open? They want to see longevity. So if you have a credit card that you've had for 10 years and you get a new fantastic credit card, like a Southwest Airlines card, and you're like, you know what, I just want to use my Southwest Airlines card. I'm just going to close out this old credit card that I have. And you're going to lose a lot of points if you do that. So you want to keep those long standing accounts. even if you don't use them. Just go throw a tank of gas on it once every few months so it doesn't, close. All right, but keep them because they're helping you. Okay, so let's look at again, these slides I got directly from FICO at a FICO training that I attended. So this is the risk factor that we're looking at. So it's the number of months since the oldest revolving account. So as you can see, the risk is very high if you've only had the accounts from anywhere from 0 to just under 2 years. You start to lower that risk at the 24-month mark. So the longer you have those cards, the lower risk you are. They see that you're managing this responsibly. You're not getting a whole bunch of new credit cards. Every time you go in and get a new credit card, you now lower that age factor because now you have a card that has, 1 month, 2 months. So you don't want to do that. You want to keep the cards you have and just work with them. A lot of times too, understand that you can call these cards that you have if you want a higher limit or you want more credit and your credit score is looking good, you can just call them. Call up an account. Say you have a Citibank account, just call them and say, hey, I've had my account here for 5 years, I need additional credit and can you increase my credit limit? If you've had a high interest rate on a card and your credit score is now great, you can call that same card and say, you know what, my credit is, 750 now, and I would like a lower interest rate on this card. You can negotiate with them directly for that. Okay, and they will lower the interest rate. They'll take a look, they'll lower the interest rate, maybe increase your limit. So you can work with your existing cards rather than getting new cards. Okay. So closing an old open account is not a great idea, even if you're not using it. Keep those old accounts open, okay? Negotiate with them if you need better terms. Types of credit, this is just really talking about mix, okay? The right mix of credit. Do you have installment accounts? Do you have revolving accounts? Do you have a mortgage? Things like that. The more different types of credit that you have, the better off your credit score will be. It's not a huge factor, but installment credit, what they're talking about is auto loans, student loans, mortgages. Mortgages are kind of their own animal. They're installment, but they're mortgage installment. So they're a little bit different. Revolving credit is just, credit cards, home equity lines of credit or HELOCs. Just so you know, that doesn't actually factor into your utilization ratio. All right, even though it is a revolving line, it's not factored into your credit card utilization and personal lines of credit. So this one I would say is not the biggest thing. Okay, having the right credit mix, it is important, but again, only worth about 10% of your score. New credit. So this is talking about inquiries, okay? You do not want to have a bunch of inquiries in the last 12 months. 12 months, again, we talked about this a little bit earlier. They only report to your credit for 24 months. They will fall off after that. And 12 months is the only time they're factoring those in. Okay, so they are taking into account, though, the number of new trade lines you've opened in the last year. So you don't want to open a bunch of new accounts. Okay, so inquiries. So here's again where I think the age factor comes into play. And I want to show you how it's different for everybody. So it's not the same based on how old your file is. So say you have 4 new inquiries, okay? That's a high amount of inquiries over the last 12 months, but you have a mature, thick credit file. As you can see on this slide, it's a lot less risk than if you have a young file, okay? So that's where that age thing comes into play for me. That's what I see. So if you have a lot of inquiries, it's not a good thing. You want to keep them down to at least 2 or less per year if you can, because you can see that the risk factor is fairly high. Okay. All right, opening new accounts all at once, definitely don't want to do that. It hurts the credit score and will result in multiple inquiries. Depending on how long your credit file has been in play will determine how badly those inquiries hit. It used to be that we would say, oh, you know, one credit inquiry is like a 3-point hit. We used to just, that was like gospel for us. So this was, again, something new that I learned with FICO. I had no idea that it differed depending on how the credit file looked. Okay, so this is just, you know, kind of going over what we were talking about, just paying down credit card balances, you know, has a positive impact on your FICO score. That's absolutely true. Having 30% utilization ratio on your credit cards results in optimal FICO score points. That's not true. It is 6%. Your monthly income is an important item considered in your FICO score. Nope, that is false. The following types of inquiries are considered in a FICO score. Mortgage applications, yes, those are absolutely considered as an inquiry. Department store card applications, I don't know why this has a little X, because it's actually, yes, it is. Employment screening is not, and insurance applications are not actually considered in a FICO score. All right, and that is the end of my presentation. Does anybody have any questions?
Thank you so much, Stephanie. That was very informative. And for if you have any questions, please take yourself off mute and ask your question. This is a good time to have all of those things you're wondering about be clarified.
If I may, I have a question for Stephanie. Stephanie, I know a lot of our business owners will, will ask us about, say their personal credit score is not, up to standard or up to par, and they are looking for business financing. And they say that there's talk that you can just have things completely separate and only use your business credit without taking your personal credit to accountability when it comes to financing for startups or for growing companies. Is that true?
So no, so that there's a lot of misinformation out in the marketplace. The truth is almost anything is going to have you personally guarantee for business credit. You can get things, I mean, they're out there telling you to go get these credit lines that have nothing to do with your business, and let's go get floor and decor, and let's go get this, and let's go get that. And I don't agree with that at all, actually. For the most part, you are going to have a personal guarantee if you want business credit. Okay. There are ways that you can do it. They're not necessarily always up and up. There's some very shady things happening in the industry. I'm part of a customer advocacy group called AWCM for compliant credit managers. And so we're addressing these things. I'm on the board of advisors there. And so we're addressing some of these things that are happening in the marketplace. But yeah, if you want to develop good business credit, you are going to have to develop good personal credit. Okay, bottom line.
There's a question in the chat that says, how can we move from 650 to 700 credit score, I'm assuming?
So that's going to be different for everybody. So the way my program works, you can't just say to somebody, oh, how do you get from here to here? You have to look at the exact credit report. So in my company, Andorra Credit Repair, and what I do is that we create step-by-step action plans for every single person. So that's what most credit repair companies do not do. Okay, they just go in and dispute, negative items or do this or that. They don't actually give you any type of plan. But it's important, if you do go with any credit repair company at all, that they're giving you a very specific step-by-step action plan based on your credit report. So you're going to want to look at things like, how do I have late payments in the last 12 to 24 months? That's going to tell you right there, you're not getting from 650 to 700 if you've had a late payment in the last 12 months. Okay. That's not going to happen for a while until you've been past that 24-month mark for sure. Is your utilization ratio high? Those are things that you can look at, that you can move your credit score right away. Other things you have to look and see, are there collection accounts that are outstanding? Are there charge-offs that are unpaid? I'm going to give you guys a huge tip right now. I actually teach credit repair courses for credit repair owners. And this is one of the main things that no one actually knows, because I am a licensed loan officer. I have access to play around with the simulators and, things, little what if things. So what I found over the years is that charge-offs, and I'm going to tell you what a charge-off and a collection, they're different. Okay, charge-off is from the original creditor, say Chase Bank or Barclays Bank or Bank of America, and I went into collections. That's considered a charge-off from the original creditor. Once it is sold to a third-party collector, now that's a collection. That's what I consider a collection. So Midland credit, portfolio recovery, things like that, that is a collection. But if you have charge-offs from the original creditor that are unpaid on your credit report, all you actually have to do is settle those and get them to change that to a zero balance, and your credit score will improve once you have no unpaid charge-offs dramatically. I've had people pay off a $79 charge-off from 6 years ago and improve their credit score just by it going to a zero balance, 75 points. Okay, so there's little things and little tricks that we know to do, so it's very hard to answer that question without seeing the actual credit report.
We have another question in the chat, Stephanie, and it says, if what you see on Experian 3 Bureau Reporting Agency differs from what a banking report looks like.
Okay, so that's not going to be the case. Any credit report that you pull from anywhere, whether it be Experian, TransUnion, Equifax, Credit Karma, Identity IQ, or a banking institution, they're all going to be the same. Okay, they're read differently. So a lot of people will think, oh, this is not the same because their credit scores are different. But again, it goes back to those credit score models. You may be getting your credit report or your score from this model over here, and someone may be pulling this model over here. But the actual information contained in that report is absolutely going to be the same.
Great. And if somebody's interested in utilizing your services, Stephanie, could you tell us what the process is that you follow, and also, if you can share what it might cost, the rates, things like that, because there might be people who are interested in that?
Yes, absolutely. So like I said, the first thing that we do here at Andorra Credit Repair is a full credit evaluation. That's where we go over everything with you on your credit report, and we create a very detailed step-by-step action plan for you. So we're going to tell you exactly what you need to do and how you need to do it in order to best benefit your credit score. We're also going to do any rebuilding with you that's necessary. So we make sure that you have the proper amount of open accounts, the proper types of accounts, and that you're utilizing them in the best way possible to maximize your credit score. We also send in any necessary disputes to the credit bureaus or directly to the creditors in conjunction with your action plan. So everything that we do here always has a very specific reason behind it. Most of our clients are going to see anywhere from a 50 to a 200-point increase over the course of our program. The program can last anywhere from 1 to 6 months, with 90 to 120 days being our average, as long as you follow your action plan. We guarantee our results. So we have absolutely the best refund policy in the industry. The bottom line is if you follow your plan exactly, you do not get your desired results, we refund 100% of your money. As far as cost goes, it's $295 for the credit evaluation and a full written action plan. And then it's $125 a month, starting the following month for the dispute portion of the program. And that's pretty much it in a nutshell. Oh, I think we lost. Do we
Yeah, it
lose?
seems like we lost.
Yes, it looks like we lost Alika, but there were a couple of other questions. So